David Fischer is a nationally recognized expert on the financial markets who appears weekly on several syndicated radio programs, including those hosted by Kevin McCullough, Steve Noble, and Joe Messina. He frequently shares his market knowledge and insight of the Federal Reserve at various speaking engagements and investment conferences across the country. David is also a precious metals expert and a regular contributor for the TD Ameritrade on their Futures program, hosted by Ben Lichtenstein. David, welcome to the show.
David, thank you for having me on your show this weekend.
Of course. You know, it's funny because, gosh, what a difference 2 years makes, huh? Last year at this time, the markets were just moving forward. We didn't even have a 3% pullback in all of 2017, and we've had several of those so far this year. What's creating the difference from 17 to 18, in your opinion?
Well, I think it's three major factors, David. I think the Fed has a lot to do with it, unwinding their balance sheet. Obviously, the biggest thing that's in the news, though, is tariffs and the effects of that on the what's going to happen next mode. But also, this is affecting human behavior on the flow of money, domestic money and foreign money coming into the markets for supporting the capital markets. So those are the three main factors. Then there's a big disconnect kind of in reference to the market and the economy. Usually they kind of go hand in hand. We've had excellent, unemployment at 3.8%. The new June report came out for jobs at 177,000 new jobs added, although it was 185,000. They thought still great number. But the economy is dictated on what the market is doing. And so there's this kind of push me, pull you going on with the rhetoric, also with President Trump and the Chinese prime minister. What will happen next? It's just kind of like the first movie of Dr. Dolittle, a being that we never heard of, the push me, pull you. And that's kind of affecting this whole environment. Who knows what might happen yet?
So let's talk about that. Let's take those one at a time. And I just assume start with the Federal Reserve, if that's okay with you.
Sure.
You know, my concern all along has been that long-term interest rates simply cannot go up very much given what's happening abroad. There's still some easing in various parts of the world that are acting kind of sort of as a governor on our long-term rates. And right now, the difference between a 2-year Treasury and a 30-year Treasury is only about 40 basis points. So how is the Federal Reserve going to raise the short-term end of the yield curve without creating a flat yield or an inverted yield curve? I mean, how is this going to work out?
Well, they might actually do what you're thinking that they might not do. I don't know that for sure, but Jay Powell is a quite different Fed chairman than Yellen and Ben Bernanke. He's data-driven, not market-sensitive, so much to speak. But the Fed is doing a couple things. Obviously, they're raising rates and trying to get to what you call normalized rates, but they're also unwinding their balance sheet, which is selling treasuries and mortgage-backed securities. To put it into perspective, in 2008, they bought these assets and used them as money to inject capital in the markets, and they did this at zero interest rate policy called ZIRP. And so they really artificially moving the market on injection of capital. That has come to a halt. They're pulling away the punch bowl, and now the market's kind of trying to stand on its own 2 feet. And by the way, the Fed in 2013 did series of modeling on computerized data to see what the effects would be by them raising rates and pulling away the punch bowl. In other words, taking away and unwinding the balance sheet. And every model they came up with, David, said this is going to cause market turmoil. So if you look at that, when we went in January of this year, when they sold the treasuries, which happens on the 15th and at the end of the month, on February 1st, we had huge 1,100-point drop in the market. It wasn't because of tariffs at that point, because those really weren't even being put into effect till March. So the pulling away the punch bowl is a graduated thing, and the Fed by the end of fourth quarter will be at $50 billion a month of retracting treasuries and mortgage-backed securities. While this has happened, though, the European Monetary Union and the Bank of Japan has been injecting money, about $150 billion into the market.
They're still easing, so they're not helping us out very much, are they?
No, not at all. But their program, they're starting to shrink down. When we get to the fourth quarter, they'll have stopped their injection of capital. And 2019 December, they're going to start raising rates. So they're going to follow. They're about 2 years behind what the Fed is, in essence. So when this happens, we're going to have a negative influx of money globally that's not going to be good on global markets. That's why a lot of people are calling for a recession in 2019, maybe in 2020.
So, David, do you think that's going to fix the problem then? Do you think that when Japan makes a change and maybe some others follow suit, that will allow our long-term interest rates to come up to keep a yield curve that's not completely flat?
I think we're going to have the 10-year above 3, maybe 3.5 by the end of the year or first quarter of next year. Jeffrey Gundlach, who's one of the bond kings, has been saying this for quite some time. He's a little bit early on his predictions. He thought it would happen by now at 3%. Obviously, we would drop back to the 2.83 level. So who knows what we're going to happen? I don't think historically, when the Fed unwinds the balance sheet, and they've done this before, not at this level though, 9 out of 10 times it's caused a recession.
Exactly, and that's what we're afraid of moving forward. Listen, Dave, I want to talk to you about that a little bit more in just a moment. We need to take a commercial break right now. And we want you to stay with us also. We have more words of wisdom here from my new friend on the income generation. We'll be right back. And we're back here with our new friend, David Fischer. David, right before the break, you were telling us a little bit about your concerns about recession, and that whenever the Fed tries to take moves like this to raise rates, inevitably causes a recession. So you don't think it's going to be any different this time from the sounds of it?
I don't think we're going to be in a recession that's severe. I think we're going to be in a moderate one, but I don't think it's going to happen in the short term here. The economy is so strong, and I think we're facing not a financial crisis. We're facing the Fed pulling away the unwinding of the balance sheet. While that's happening, a lot of uncertainties with tariffs that's compounding the issues of people what to do with their money. And should manufacturers expand right now in this great booming economic cycle of businesses being able to grow with lower tax rate? So it's causing confusion. Once we get past the tariff, I think we're only going to deal with the Fed unwinding the balance sheet, and that's a beast that's unknown because how large the balance sheet is at $4.5 trillion, and it was pre-2008 about $880 billion. So we're going back to normalization. What is that? $1 trillion, somewhere around there is what projections are. That's a big sell-off, so we don't know what the effect that will be. Some say it could be catastrophic, like Jim Rogers. He's calling for the biggest recession we've ever had in our lifetime. So I don't know if I'd hold that sentiment, though.
So now, how about demographics? You know, you mentioned Japan earlier, and one of the things that's kept Japan's interest rates lower over the last 20 or 30 years has been their demographic trends, aging population, which we are now having as this big generation, of which I'm a member, the baby boomers, is starting to spend less, starting to save more, and pay off debt. You know, are we ever going to be able to see a 10-year at 4.5 or 5 again, or is that demographic trend, people looking for fixed income, going to change and keep a long-term governor, if you will, on our long-term interest rates?
You know, things are quite different in this decade compared to even 15, 20 years ago.
Sure.
Obviously, in many aspects, we have cryptocurrencies, which was never thought about here just 4 or 5 years ago on a standard main environment where we could invest in. I'm not supporting cryptocurrencies, but as technology changes, the environment's going to change, and to invest in this decade compared to how it was pre-9/11 is just absurd. So who knows? Japan might be the new model, David. I would hope not, but you know, because we don't want to live on fumes and be in a recession for, you know, they've been in recession in essence for 18 years. So it's not a good economic model to go by. We're going to lead the charge. I still believe America is the greatest nation on earth. We're just hitting some speed bumps. We can't get out of the parking lot right now onto the superhighway because there's so much massive uncertainty. I say we're going to get to higher rates because when you look at the Fed, 1/4 point is an artificially low rate that we had for 7 years, and the high rate of 20% is totally ballooned from inflation in the 70s, early 80s. The normalized rate by the Fed should be about 5.3% when you amortize it over that period of time. The Fed is targeting 3.5 to maybe 4.5%. I think they're going to hit their target, and I think that's going to cause an inversion of the yield curve, and I think that's going to be our normalized rate. But I think things will adjust accordingly.
That's probably what's going to cause the next recession, is the inverted yield curve. Absolutely.
Yeah.
David, can you stay with us for one more block? I know you've teased me a little bit about the trade war, so I do want to talk to you about it. I want to have you back. So stay with us. And you stay with us, too. We have more words of wisdom from David Fischer. We'll talk about the trade war and how it may or may not affect the markets. We'll be right back. And we're here today with the newest friend of the income generation, David Fischer. Now, David, you were talking a few times about this possible trade war and what this is going to involve, the tariffs. So let's have that conversation about how you think that's likely to affect our economy and, I guess, more importantly, in some ways, for our viewers' portfolios, how it's going to affect the stock market.
Well, some people are even asking, why are we having tariffs? Some people say, we got to get this trade deficit under control between China, so $375 billion. Some say it's not about that. It's about having a level playing field with all countries, the EU, Canada, Mexico. Some say it's just, we got to expand America, and this is how we're going to do it. But whatever the reason may be, and I think they're all listed above in President Trump's mind, tariffs are causing the global supply chain to be challenged, and in some cases might even break it. What I mean by that, let's take a stock that just got taken out of the Dow, General Electric, who trades with 20,000 companies from around the world. And they take in all these different supply chains and create a manufacturing process and send that end result product abroad. Mm-hmm. If that's relating to the automobile industry, and the tariffs go into effect of $45 billion cost would be to the automobile agency, because we sell around 200 million automobiles abroad every month. So it's quite a bit of a push down on our industry. I mean, Harley Davidson is being forced by their own admittance to now diversify and establish a presence in Europe, because that's their second largest entity that buys from Harley Davidson, which is an icon of American motorcycles. The American market has shrunk 12%. So they got to do something, either stay alive and evolve and get some of their outsourcing abroad, or die and be one of the countries, companies of the past that does this. So tariffs are throwing on, the process of steel and aluminum, throwing on a tax that gets passed off to the consumer, unfortunately. We'll see if this actually works or not, but it's causing the global supply chain to be uprooted. Next week's going to tell a lot once these big tariffs go into effect.
So, David, if it's a trade war is not if it's a zero-sum game in some ways, then I guess the question becomes, who has advantage here? Are we strong enough that we have advantage in a trade war, or do we have a disadvantage? Can we be net winners or net losers?
Depends on who you're talking to. China thinks they have the upper hand. They just lowered their rates by 0.5%, injected $750 billion into their system to support this. They're going to input 543 tariffs on our products representing soybeans, bourbon, steel, aluminum, and different other products, so that will they sell our currency, the $1 trillion, the $1.5 trillion that they hold, that actually gets put in their place as our benefit when there is this trade deficit? So do we have the upper hand and say we need to win because the World Trade Organization hasn't been doing what they should have been done all along, and China is stealing our technology through transfers of technology? There's a lot of ifs out there. Who will win? I don't think anybody wins historically in a trade war, but we might have the upper hand because this is about the president wanting to make America great. So I don't know if this is the route that he should be going. That time will tell that.
I think the president believes there's and maybe he's the first one to have the guts to do it, but I think what's happening here is the realization that sometimes there has to be a little pain short term to have good long-term economic solutions and to make the tariffs more equal. From the stock market, my only hope is that smart investors can now do what you said earlier on, that let's not invest now the way we invested in the 1990s or even the early 2000s. Let's look at companies that could benefit from a trade war and stay away from those that might hurt. So, David, we need to leave it there today. Thank you very much for being on our show. It's good to have you.
Thank you, David.
And you stay with us too. We'll be back with more here on The Income Generation. We'll be right back.